Hello, my name is Nathan Bird, founder of Acquicon Acquisition Conference, coming to Salt Lake City March 21st, 2025. And I'm joined here with one of our special guests, Omar Melo. He's an investment banker, has been in the industry for over 15 years, has seen hundreds of transactions, hundreds of millions. So please share with me a little bit more about why you got into the investment banking as well as a bit of your history.
Yeah, absolutely. So I think why kind of goes back to really kind of family and where I came from. My parents were immigrants, came here to America for upward mobility opportunities to improve their life, and they taught me that it was a responsibility to help others. And so, in the first instance, I decided, okay, how am I gonna really um, take advantage of the opportunities that my parents created for me by coming to this country as immigrants. And so I set out to, learn finance because I felt like that was really the essence of the
Mhm.
of upward mobility, being able to just um, understand the language and how finances work. And so I came to Brigham Young University, which is what brought me here to Utah, and got a degree in accounting, and then came back, got a degree in law. My first love has always been in finance. So I started out by going to Hong Kong and working for Source Funds. It's a long story how I ended up there, but that was my first career job. And then I went to Merrill Lynch in New York, and then I ended up with Bank of America Securities in San Francisco. So Wall Street was almost 10 years. It was really about 8. And then I was an entrepreneur for about 15 years, and then I came back to what we call lower middle market banking. So Wall Street was, big billion-dollar transactions, taking companies public, and then here at Crew Capital, we focus on what we call lower middle market um, segment, types of transactions. Yeah.
One thing I really enjoy about your story, and you've shared it with me, was like you said, it was family of an immigrant, but then also you had all this in front of you, and you made something of your opportunity. And I know this podcast is primarily about acquisitions and different sell side and whatnot within your business, but there's always a story behind somebody, and I love that story and how it's propelled you to your current state. So share with me. We're going to dive into the actual acquisition of a business, but also let's preface before we dive into that some of your experiences with the businesses that you've consulted on from the buy side of a
Yeah.
transaction.
Yeah, no, absolutely. And I will say, even though it's easy to get really clinical and deep into the numbers of things, at the end of the day, uh, when you buy a company, you're buying the people, right? I mean, it's a colossal mistake to not consider the culture of the company that you're buying. Um, the the maybe the some of the intangibles of those companies and the culture. It's where if you buy a company and the people on of that company and they're if kind of how they've been trained or
Mhm.
the reason that they've joined the company don't necessarily align with your vision. There's just so many stories of acquisitions, mergers that failed because of that one thing, right?
Let's go through a failure that you've been a part of.
Maybe there's many, but probably the one that comes to mind really quickly is I was a part of one.
Okay.
I was an employee, and Nations Bank, who ended up buying Bank of America. But before they bought Bank of America, they bought the firm that I was with was Montgomery Securities, culturally there was a big clash between the two, our company and the acquirer,
Mhm.
and when after the dust settled, right? I mean, there were turf wars going on left and right, lots of lots of backstabbing, and
Mm.
you know, investment bankers are known to be, um, they're aggressive,
Yeah.
and they're very bottom line oriented for the most part. And culturally, investment banks are flat organizations. It's very much a meritocracy. And a traditional bank, which was Bank of Nations Bank, the culture is very, very different. And and ultimately, what ended up happening was, after kind of the non-compete period was over of the contract, half the staff left, and another firm was created, which was Weisel Partners. And all of this was aired in the Wall Street Journal. I mean, and there's many, many other mergers with very similar stories. But the smart private equity or the smart investors, you know, the numbers are just the starting point, and then you have to dig in deeper and look at the motivations of those that are going to stay
Yeah.
on and continue on, and do they have the motivation to move forward, and do those plans align with the acquirers or yours?
What do you feel is the mm, probably number one reason, based on some of the trends that you've seen and experiences you've had with the failure of the transaction? And then we'll get into, of course, buying companies and
Yeah.
whatnot.
So for me, it, my role is to bring the capital to my client who's doing the acquisition. So we run a process. We go out to market, and we go out to institutional capital providers, um, and so we marry up our client, who's typically an industry veteran, an entrepreneur, and we marry them up with a capital provider that's going to help our client see their vision, through the long haul. Um, and if I could say, so that's our process, right?
Hmm.
That's how long we're involved. As soon as the transaction closes, we're no longer a part of the venture. So, um, how I've seen it fail, the number one reason I would say is when the company that's being acquired, doesn't perform well. So it could be for lots of different reasons. It could happen a lot of different ways, but the simplest of ways is simply that the seller represents the numbers in a certain way. They say we have X amount of revenue, we have X amount of profitability, and then the parties get under LOI, and then they start to do due diligence, and then come to find out that the numbers aren't what were represented by the seller. And it might be, oftentimes it's the seller didn't really know, because the seller's not sophisticated enough, didn't really, maybe really wasn't doing their financials, using GAAP or accrual basis accounting. They were just running cash. And once all the adjustments were made, as it turns out, maybe they weren't doing well as they thought they were doing. Um, or while we're in the process, maybe the numbers are correct, but it takes time, right? Could take a
Hmm.
couple months, could take 3 months, could take 4 months to to execute on the transaction. Um, and during that time frame, the company starts to falter.
Mm.
They start to underperform, and then when that happens, the buyer all of a sudden gets cold feet, or the capital providers, don't uh, all of a sudden get cold feet as well, and that's how most of the deals that I've
Mhm.
seen fall apart, is the performance of the target company. So, which is to say that if you're the acquirer, before you start spending a ton of time, you really got to understand those numbers
Mhm.
to make sure that the numbers are what the seller says they are, at least have somebody on your team
Yeah.
to help you go
Well,
through
I
that.
just see there's a massive gap that business owners have, actually, with the the proper organization of their company structure for a potential exit, but then also for the acquirer having the education, knowing the barriers, knowing the challenges that they're about to walk into. That's exactly why we're doing the podcast.
Yeah.
and interviewing people just like yourself to provide that education and insight before you get to that major roadblock, both as a buyer and a seller. Let's talk about the acquisition of a company. So, walk me through the steps. You've been in multiple acquisitions. You even have shared with me various strategies and procedures that we'll talk a little bit later, like multiple arbitrage. But share with me a little bit about that step, maybe 10-step process through an acquisition.
Yeah. So in the first instance, you've got to find a target company, right? So there's all the exercise of deal sourcing, going out and finding the company that's ready for sale. So that's step number one, right? And maybe even before that, you need to have a plan, a strategy. Why what you got to map out in your head what is the right company that aligns with your strategy. And I recommend, of course, is that if you're making acquisitions, you know, is that it be in your domain of expertise, companies that you know about. And obviously, this makes a lot more sense for companies who are buying other companies. So, then it's easier to kind of figure out what's your strategy because you know your industry inside and out. You know who your competitors are. You know where the gaps are in the market, and you're looking to buy these, acquire these companies to help you fill in the gaps in whatever way it may
Hmm.
be. So there's lots of reasons to make acquisitions and to grow through acquisitions. And it could also be that growing the acquisitions is not necessarily the best strategy for you. So, so number one is, do you want to go through acquisitions? And if you do, then what's the profile of the companies that you're looking to buy? And what I and a lot of the smart capital, a lot of the private equity firms, big part of their criteria is buying companies that starting out with the first acquisition being a platform company, which is to say that it has systems and processes in place so that if you buy other companies, they can plug into those systems and processes. But so in the first instance is, hey, identify the kind of company that you're looking to buy. The second, after that, is you're trying to understand, get to know the company. So as you kind of get to know them, you're going to be asking for financial information to understand their financial performance. You're gonna, and in that evaluation process, there's a lot to digest, which is everything from, do they have too high a customer concentration? Are they operating above? Are they overperforming compared to their competitors, to others in the market? Are they underperforming? Lots and lots of different variables that you want to take into consideration.
Real quick, in regards to that process of looking at everything that the value of the company has, or all the value that's packed in there, what are some of the most important things that increase or decrease valuation? For example, there's intellectual property. Number two, long-term contracts that would increase the overall valuation, assets that the company has. But what else are intangibles that you're looking for?
Yeah. So, um, you know, va- valuation, I look at it as kind of a curve,
Okay.
and you know, for every industry, there's some curve. It's usually kind of a bell curve looking thing, and most companies are going to be valued in kind of right underneath that bell curve in that 50% kind of range. And then there's outliers for the ones for those companies that have much higher multiple valuations. And so oftentimes, I think kind of what you're getting to is, how do you become an outlier? How do you become one of those companies that's on the right side of the tail, right? That's
Hmm.
outperforming the average. And the number one driver is usually growth, right? If you're growing quickly, and what it means to be growing quickly really kind of depends on the industry, but generally, tech companies, if you're kind of growing over 20% per year and you've been doing it consistently over a period of time, then that's considered pretty good growth. Um, if you're kind of doing, you know, over 100%, then that's kind of hyper growth, and those are all those are certain indicators of that of how you might start to um, uh, you know be in that be an outlier in
Hmm.
terms of valuation. Certainly, if you got some deep patents, generational patents that are hugely disruptive, in the industry, because you got some sort of deep technology. Those kinds of things can also impact it. Uh, the one thing that I see that is usually what really impacts value is some of the other things maybe people don't think about is if maybe you've locked up some channel of distribution, right? For example, and then there's no other competitors, and it becomes obvious that hey, that you've got it locked up, and you go to one of the competitors, you go out to some of the other, you go out to some of the uh, others in the industry, and you have a bidding war, right? Then it's like, oh, well, I've got to have that. Nobody else, if I get that, nobody else has it, right? So whatever your moat is, the way if you can build that moat, the higher that moat is, the more value that you're driving to the company.
When you say moat, you're saying that you in essence are capitalizing on maybe an entire market or a
No,
portion of
meaning
the
moat
market.
meaning something that's unique to you and that provides protection against the
That's good.
competition,
Yeah.
right? And it could be intellectual property, it could be um, you know uh, locking up a distribution channel, locking up a resource,
How
things like
much
that.
does team play into the overall valuation of a company?
Team,
Hmm.
yeah, no,
Personnel.
yeah, it, it, it's it, beauty is kind of like it really in the eye of the beholder.
Mhm.
And so if a company is lacking or they complete you in some way, because they're missing some pieces of the puzzle, um, that's pretty valuable to them. If they're buying you and they've already got the talent, and they're going to trim, then it's not as valuable,
Okay,
right?
I see that.
So it really kind of depends on what the strategy is to acquire.
So we were in stage two. That was in essence do the due diligence. You've got your target. Now we're moving into the process of understanding the valuation within the company and everything that entails. What's stage three?
You got to get capital, right? You got to line up your
That's
capital.
your middle name,
That's my middle name. Yeah,
Omar
yeah.
Capital
You served
Mello.
that one up for me. That was an easy. That's a layup. Yeah, yeah. No, so you gotta have the capital to be able to make that acquisition, and depending on the size and what.
Let's talk about three unique, creative capitalization methods that you know, or maybe even more because you've probably seen it all. But
Yeah, no,
yeah,
I mean, I'm learning every day.
yeah.
Nobody knows everything, but and it's really up to the parties, how they structure an acquisition. You know, there's no perfect playbook. It's whatever the parties can come to an agreement on, is how you structure a deal at the end of the day, right? Um, but most of the time it's the seller just wants to get paid, and the buyer wants to acquire a company that is not going to be a dog, right? Um, and whether you buy 100% of the company or you're buying 80% of the company, um, is really a little bit of kind of how you view and manage risk. A lot of institutional buyers prefer to buy, um, you know, prefer to buy a company where the seller is going to roll over equity, because that's a huge vote of confidence that the company that's being sold has some value to it, because the seller's willing to roll over some of their equity for for another bite of the apple down the road. Um, and so you asked me about structuring,
Mhm.
and that's one way to employ some creative kind of structuring, but that gives you a little bit of a safety net that you're buying a company that's going to be a going concern. It's not just going to dry up because the seller is providing that kind of vote of confidence. The other piece to it could be, another component of the financing could be an earnout.
Mm.
Uh, so that is an instrument where it's an agreement simply that the seller is going to get paid based on the future performance or based on some future conditions, right? And most of the time, those conditions are that the company is going to perform at a certain level or better or something like that. So it's meant to be a little bit of a safety net for the buyer, and it's also meant to, just like the rollover equity, a way to tie in the seller into the future, get him to participate in and help the future
Build. Yeah,
success
yeah.
of the company, right? And then the third kind of um, iteration is seller financing. Again, now the seller is, it's not as good as rollover equity and earnout, but it's still a vote of confidence. Like, oh, okay, well, here's my financing terms, and I know I'm expecting to be paid based on the future performance of the company, and that's what I'm banking on. That's what the seller financing is meant to do. So,
Is there ways that you can combine one or the other?
well, there usually are. Yeah, they're usually a
Okay.
mix of all three or two and there's lots of others that you probably don't want to get into.
So
But
SBA, private money, but then of course you've got to have an investment vehicle for that acquisition, you know, or as far as from one company to the other, how do you put that together?
that's really something that you figure out with your attorney,
Okay,
right?
yeah, that's good.
It's not, how it needs to be structured can depend on the industry. If you're buying a healthcare business and there's all kinds of regulation
Yeah.
and who can own
So as an investment banker, you're suggesting that you speak with an M&A attorney or just a business lawyer, or who's the
well,
best
there's
attorney
different
for that
roles,
specific?
right? So an investment banker um, can help raise the money. They
Mhm.
could help the company find the target company to
Mhm.
acquire. Um, they could help evaluate the company that's being acquired. They can help the acquirer evaluate the target company.
Yeah.
So that so the investment bankers plays that role, and then there's the attorneys, right? That write up all the contracts and really kind of help protect um, the buyer and the seller. Just each one's going to have their own attorneys, and then you have the financial guys. A big something that institutional buyers usually have in place is a quality of earnings that does all the financial analysis.
So you're a buyer right now. You're at the negotiation table and you're negotiating with me right now. How are you going to get the best deal?
Um, yeah, and that's interesting you ask that question because my approach is how are you going to get a, a good deal, a win-win deal? Because again, if you s- if you're buying a company and the seller and um, you're just trying to um, get a, s- a deal that maybe isn't good for the seller, then they're not going to be incentivized
Hmm.
to help you with making sure that that company succeeds into the future, right? Especially if they're going to stay on for a certain period of time, they're rolling over equity, they're different things like that. So you're really looking to negotiate a win-win for both parties.
I love that perspective. I think that you're right. People don't really, and that, well, sometimes I'm sure they do, but other times they may not think about if they have a bad taste in their mouth after an exit, like you said, how long are they going to stay on to actually help with the success of the future companies? You've got to take that joint venture approach,
Mhm.
really.
Mhm. Yeah, I think it makes getting the very best deal probably works a lot better for real estate
Hmm.
because it's just a hard asset at the end of the day,
Yeah,
right?
that's
And
good. Go ahead and just click it again. Oh, 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 perfect. So we're almost done with the acquisition process. You wrap everything up, but man, it sounds like you've had a lot of experience, of course, with a multitude of businesses, you know, uh, and a deep understanding of the acquisition process. So if you were starting a business yourself, or if you're in business right now and you're looking to acquire a company or create this, long-term vision that's a little bit bigger than maybe just owning one company, we talked briefly about multiple arbitrage and how that's a possibility. What does that mean, and how can a business owner apply that?
yeah, multiple arbitrage just means that you're taking advantage of the uh, the pricing of small companies compared to larger companies. And generally speaking, in most industries, larger companies trade at a higher multiple um, than than smaller companies. And so, as you're a larger company and you're trading at a higher multiple, and you buy smaller companies, they inure basically the same multiple that you have um, as when you buy them. And the rationale for the market is, that to ascribe a higher multiple is that, well, they're part of your company now, and they've
Mm.
got the same advantages that you're having because they are your company now. So
Such a good theory, and I think a lot of people really should look at that. Well, guys, I just want to say thank you once again, Omar, for joining us on the Acquisition IQ podcast. And thank you again, audience. Hope you guys enjoyed the interview here with Omar. And if you guys are interested in potentially meeting Omar and other entrepreneurs just like him at our upcoming conference called Acquicon Acquisition Conference, just go to Acquicon.live. Make sure to get your ticket there. But once again, thank you so much for hopping on the podcast today.
absolutely, thanks for having me.